Hey everyone, we're here for our next session. We have Andrea Lowe from Stellar. She'll be doing a talk on making money the traditional way, Cefi business models. Andrea, would you mind introducing yourself before you dive into your talk?
Sure. Thank you, Shinju. Hi, as she mentioned, my name is Andrea. I work at the Stellar Development Foundation, where I lead the Enterprise Fund. We are a $600 million fund that invests in companies building on top of our blockchain network. I've spent the last 2 to 3 years working at the intersection of traditional finance and fintech and blockchain, and I'm excited today to speak to you about CeFi business models. Thank you. So today I'm going to quickly go over some general definitions so that we are on the same page for common business models in CeFi, and then share with you or try to convince you of why you actually care. So I'm going to dive right in. So let's just get the definition straight. So CeFi versus DeFi. What is the actual definition? So CeFi stands for centralized finance. This typically refers to traditional finance and banking and parts of fintech as well. And this is defined by the fact that all of the organizations are controlled by a centralized body, as most of you know. And then I would say that fintech's definition is technology and innovation that aims to compete with traditional finance and delivery of financial services. And I would say that DeFi is a part of fintech, but DeFi goes even further to kind of rebuild and reimagine the entire infrastructure. So someone laughed at me when I talking about CeFi at a DeFi conference, but I guess we're all maybe crypto natives and millennials, so hopefully this is a helpful lesson for everyone. So fintech was the original revolution we were promised. We were promised that fintechs would chip away at banks, but after 10 years, fintechs have really served to just chip away at disrupting the distribution of financial services and not really the infrastructure like blockchain and like DeFi have. So you'll see from this chart, last 10 years, slow but steady progress, chipping away from the banks, gaining market share. And I love this quote, which argues that right now, fintech is not a revolution. Every fintech is really just disguised as a strategic growth hack where the real goal is to become a bank. And so I'm going to talk a bit about both traditional finance and fintech today from a CeFi model. And there are typically three, they're not moving. Slides aren't moving. Let's see. Okay, can you see the slides? I haven't really moved. You still see the first slide. Oh, okay, yeah, it's moving. Sorry, I was confused. So there are three common fintech models which do not really reimagine the infrastructure. And this typically is what's common is kind of a user interface play. So they'll build a new front end and use the existing back end. So an example of this is Lemonade, an insurance company that makes it fun and easy to get home and renters insurance that just went IPO. And then you'll have kind of new layer twos. So they'll be building on top of existing infrastructure and existing rails to create a new network. So that's something like Venmo. And then you'll see people unbundle and rebundle services provided by the banks and re-offer that. So that's things like Cefi and Robinhood. And so that's a very common model right now for fintechs where they start with a specific use case. So Cefi for student loans, even Coinbase for crypto, and then they will eventually expand horizontally to become a bank by offering basic banking services. And so one more definition for you is neobanks, typically online-only banks that work with partnering banks, and then challenger banks, which actually have their own license and are typically digitally first. And so as you can see, most of these are just built on traditional infrastructure as well. So now I'm going to dive into 4 common CeFi business models. So the first one is a pretty big and obvious one, and probably something you guys are familiar with as well, but it's really the game of deposits. So the name of the game for banks is really collecting a lot of our deposits and minimizing the interest they pay on our deposits, and then turning around and charging high interest rates to lend or reinvest that money. And so what's crazy to understand is that banks are only required to hold 10% of reserves. So that means that they can lend way more, they can invest way more beyond the actual deposits that they have on hand. So for example, based on the 10% reserves, they can make loans up to 10x the amount, which is an insane business model, right? And so there is some regulation where there's capital requirements that ensure that you are always having a certain ratio of capital to existing assets. But this makes for a pretty nice business model. Get cost of capital for almost nothing and then turn around and lend it. So another update is before COVID, the Federal Reserve required most banks to hold 10% reserves. If you were a smaller bank over 16 million, you had to hold 3% reserves. But now post-COVID, that they've reduced the requirement to 0 across all deposit tiers. So banks are making money right now. So again, there is a battle for deposits across big banks, digital-only banks, fintechs, community banks, and credit unions. And you could argue that they're not really trying that hard, actually. Big banks currently pay almost a 0% APY. Digital banks pay a little bit better because they have lower cost infrastructures. And then fintechs also pay a little bit better because they typically work with partnering banks that will hold and invest the money. And so that's why you'll see when you open an account with Robinhood or a Betterment, it'll take a few days to transfer your money or settle trades and get access to that. Community banks also are similar to digital-only banks. They have better rates because they offer things like CDs and higher interest checking accounts, but because they don't have to pay for physical branches and costs associated to that. And then credit unions, today I found one that pays 4%, which is not bad, but nowhere near kind of your guys' yields. And they are kind of tax exempt member-based cooperatives. And so they tend to put their members first. So they're able to typically offer higher rates on savings accounts and deposits, and then they turn around and offer members lower interest rates on loans. So you'll see that there are a couple different levers that banks try to attract you with for their deposits, whether it's no fees, hidden fees, rewards. They're not trying that hard. Let's be real. But the crazy thing is the banks still have a ton of deposits. And so here's a list of the top 15 banks by total assets. And you'll see here that the average bank actually holds $4 billion in assets. It's just kind of fun to compare that with total value locked in DeFi right now. So you could imagine that we could surpass a lot of the asset side, the deposits of DeFi. So honing in on kind of the big 4 banks in the US, they've remained mainly the same 4, and they make a lion's share of their revenue from interest income. And so they currently hold over 40% of all deposits. That's over $4.6 trillion. And again, a lion's share of that is just coming from interest income. And then since then, they've vertically integrated to kind of capture the market, and offer other services besides deposits and loans. Each bank's slightly different. Wells Fargo has slightly a more community focus. JP Morgan focuses on slightly a higher end clientele. And then Citi is a bit more an international, for example. And so, as I mentioned, banks over the years have become very, very, very much vertically integrated, and they own their own entire value chain because they are the supplier, the producer, and the retailer. And over the years have just gotten not very efficient because they are dealing with so many different things. And so you'll see in this image on the right, the bank has started to become unbundled by fintechs targeting very specific segments. And so you'll see that open banking is a current trend with banks where they are starting to unbundle financial services through APIs. And so this is a ploy to keep their customers, to keep their deposits, and to have other people, third parties, access their customer data, their payment services, and plug in through APIs. And so these APIs typically have 6 different revenue models. But again, at the end of the day, this is a way for banks to keep their customers, keep their deposits. And so you'll see here, it ranges from charging by API fee, by API call to different apps maybe built on top that would monetize on additional data and insights, or rev share with some of these third parties hooking into the open banking initiatives. And so, yes, banks have our trust right now, and open banking is being forced in Europe, and we're seeing all the big banks have open banking initiatives. But yes, the cost of trust is baked in. DeFi is definitely much more risky. Thank you, Howard. So the second business model that I'm going to talk about in Cefi is card fees. So I mentioned earlier that there are digital banks that are online first. So one example is Chime, another one is Revolut. And they don't quite have enough users or enough deposits to really use that strategy. And so they actually make most of their money from card fees. So for those of you not too familiar with these banks, they typically are able to acquire a specific segment of users at slightly lower cost, and they'll target that segment and then provide features that hook those segments in. So Chime, for example, targets a user age 25 to 35. Typically, they make 35 to 70,000 a year. And these people trust startups more than banks. They are tired of being nickel and dimed by the larger banks. They don't like going to physical locations. And so you'll see here that Chime offers features for that specific segment where they give 2-day cash advances based on kind of direct deposits from your salary. They have a free debit card, slightly higher savings account yields. And then Revolut started by focusing on frequent travelers, a lot of expats, exchange students, people that have a lot of payment needs around using different currencies. And so they focused on exchanging money with no fees, as well as being able to use up to 28 different currencies. And they now have $12 million. Sorry, not $12 million, 12 million users. And so you'll see that's typically an app, and they always have a debit card or some kind of card that they issue with Visa and MasterCard. So you'll see literally their products look almost the same from the picture and have a card. So how does the card fee work? So every time one of their users goes to pay with their debit card, MasterCard or Visa will charge the merchant a small percentage for every transaction. So you'll see here in the diagram that the merchant will then send the transactions to their own bank. That bank will then submit it to the card network. And then the card network will hit up the issuing bank. And so in our case, that's Chime and Revolut to process the transaction. If it is a debit card, the fee is a little bit lower. If it is credit, then they're taking on a little bit more risk, and that issuing bank or entity is actually making the loan so that you can, or giving you the credit so that you can go ahead and purchase in advance. And then at that point, they take an interchange rate before sending the money back through the chain, through the credit card network, back to the merchant's bank. And so that is where they make a small percentage on the interchange rate. For the merchant, that is called a merchant discount rate. And so, as most of you guys know, when you go to pay with a credit card or debit card, people will try to incentivize you oftentimes with cash because they're paying on the back end anything from 1% to 3% for you to process that transaction. So the crazy thing is there's all kinds of different card fees associated with this, to the point where I actually learned this recently, where if you swipe your card versus it's actually keyed in, there is a different interchange rate. There is a different interchange rate for all kinds of different entities. And the reasoning behind that is there's slightly less risk if you swipe it versus if someone were to key in the rates. So it's really, really interesting. And so obviously I mentioned Visa and MasterCard as the payment processing. And so I'll talk a little bit about how they make money, but they are processing your transactions, not doing more than that. And so as I mentioned, they're taking a portion of the interchange fee. They are and that is obviously based on volume of transactions. But then they're also charging kind of two additional sources, making revenue in two additional ways by the actual processing. So there's a fixed fee based on actually moving the money and settling the money. They will charge every time your transaction is authorized. They will charge every time the transaction information clears between two parties' banks. They will actually even charge when the funds settle. And then they also make a decent amount of money from international transactions because now you are operating outside of their network. And so there's a lot of opportunity for them to make money on currency exchange rates as well as other added fees that you are charged when you are, for example, traveling in Paris. One other company I wanted to bring up, which is an interesting contrast to Visa and MasterCard, is American Express. So their slight different tweak on the model is that they not only do the processing, but they also do the lending. And so you'll see in that diagram that American Express is not only the credit card network, but they also end up becoming the issuing bank. And so cardholders will not be borrowing from kind of this other issuer like a Revolut or Chime or Chase Bank. They will be directly getting the money from American Express. And American Express has really differentiated their model by being able to target bigger spenders. And they also actually charge merchants more. And so that's why sometimes when you go to the store, they will not accept American Express because they don't want to pay for that extra fee. But users of the card love it because they have fancy rewards and perks, but at the expense of being accepted at less places and with slightly higher fees for merchants. So that concludes the card fees. I'm now going to move into third-party commissions. So for most of us in blockchain, we absolutely love cutting out the middlemen. But unfortunately, there are still a ton of different middlemen in the world. There are a ton of brokers, and they are all paid by connecting a buyer and a seller. They are not necessarily providing much value beyond just connecting the buyer and the seller. And then the seller typically will pay the middleman commissions. So believe it or not, there are 101 different brokers. You're probably more familiar with broker dealers, brokerage firms, real estate brokers, but there's pawn brokers, there's yacht brokers, obviously stock brokers, insurance brokers. There's a lot of brokers that we have not cut out yet. So I think you guys have your work cut out for you. And so the financial services industries tend to pay the most for lead generation because they make a lot of money per per customer. And so kind of the top 7 industries where you'll see this lead gen and like third party commissions is the insurance industry, a lot of remodeling and home services, legal, education, the credit card companies. So there's a lot of referring websites like bankrate.com or NerdWallet. And then there's also real estate's a huge industry because you're getting such a big loan. If you're refinancing, the brokers will get paid sometimes just to refer a refinance. They'll get paid $10,000. And then the last one is kind of assisted living. So people being placed into homes also will tend to charge for that. And there's a couple large referring websites, as well as there used to just be in-person brokers, I suppose. So I'm going to cover one specific use case of third-party commissions, which I think you guys will find interesting. So targeting online brokerages, our favorite Robinhood. And what I think is interesting about their business model is they moved into an extremely crowded industry with a lot of discount brokerages like Charles Schwab that have a lot of AUM. And they really decided to streamline how they made money and optimize on one particular flow, which was commissions. And so while they do charge for fees for like margin trading and interest on some of their customer deposits, they actually make the most money specifically from payment for order flow. And so this is how they've been able to really enable free trading. And so I would say that they really differentiate themselves by really optimizing for this one revenue stream. So what payment for order flow is that Robinhood actually will send their your orders or the orders in general to market makers and high frequency traders for execution. And they make money on the spread. And so specifically what Robinhood does is they will automatically send your order to their partners that are market makers. And it has to be based on the one that will give you the best execution. And then they have a range of market makers that they use who all promise to pay them the same rebate and commission at the same rate. And so earlier, I think last year, they got in trouble for not working with enough folks. So they've expanded that list of people they work with. So you might be asking, why would people pay for the order flow? So on the left side, you'll see these are kind of the main firms that they route orders to and how much they are paying, how much payment they're getting from each party. And so these market makers are purchasing the order flow because it offers better prices than public exchanges like NASDAQ and trading on the NYSE. They also like to be able to execute their orders off exchange to avoid those fees. And there's less risk associated with the retail flow. So it would allow for better prices and also allows them to not have to compete with more sophisticated traders. And so you'll see, even though Robinhood has lower assets under management compared to the others and a lower average account size, they're doing pretty well because they have optimized this flow. Most of the others charge for a fixed per share basis, and they decided that they were going to charge for a fixed rate per spread. So you'll see in this chart, the rates are all pretty good, despite having less users and less AUM. And people tend to pay more because they are introducing a new demographic that's different than Charles Schwab, that's different than E-Trade. And you could say that these people offer some diversity, different size trades, different sector preferences, as well as different trading strategies, more or less aggressive. And so this has become quite profitable for these market makers and high frequency traders. So there is a lot of incentive to bring new segments of users to the market and different ways to optimize on making money on those segments. The last model I'm going to talk about is pretty self-explanatory, but it's assets under management, which is probably something you guys will understand straight off the bat. But similar to deposits, there is also a cutthroat battle for assets under management. And so typically these organizations will charge as a percentage of the total market value of assets that they have under management. And the fees will be expressed by basis points. So you'll see this for mutual funds, financial advisors. Believe it or not, older people use financial advisors. And then banks and insurance companies also will have their asset management arms. And then asset managers themselves, which deal in anything from equities to real estate, and then robo-advisors who are trying to automate all of this. And AUM continues to grow. You'll see in this chart through to October 2020, AUM in North America grew, I think by, I'm looking closely, 20%, Japan 25%. So it continues to grow, and people are looking for yield as well. So similar to the big banks, the top asset managers have not changed. It's still the same couple of players. BlackRock has trillions under management, and 80% of the assets they deal with are actually equities and fixed income. So there's not actually that much diversity. Definitely barely any is making it to crypto right now. There's also typically a differentiation between passive management and active management. And there's a general trend towards passive management because some people argue that active managers are not making better returns and just charging you more fees. And so you'll see from this small chart here that the top 20 funds, typically about 66% are just individual independent asset managers. And then the rest come from banks and insurers. So why do we care? It seems like you guys are already seeing some parallels. But regardless of how we have this incredibly robust legacy financial system, we have fintechs that have promised to bring the revolution. We've also have DeFi that promises to bring the revolution, but there are still a ton of key problems that exist. There are 1.7 billion people in this world that are still unbanked. I mean, I mainly talked about the US today. Don't even get me started with emerging markets. There's all kinds of other models in those countries. We still have financial crises. There is, as you can see, almost 0% interest rates from the banks who are turning around and making a ton of money on your dime. And there are high fees, slow transfers, slow settlement, and not everyone has access to capital. And then wealth inequality continues to increase. This is a really interesting chart. It breaks it down by the top 1% versus the top 90% and those in between. And you'll see that the top 1% own over 50% of equities. And that's like the predominant strategy right now. So a lot of people are being left out. It's interesting to see that real estate and pension funds are a little bit more equal, but this is only contributing to inequality because people are being able to invest their money. And though we've made great bounds and leaps with progress in DeFi, we're still missing use cases for everyday people. And so if you look at adoption as value minus friction, we're all very aware of what the friction is right now. Value continues to increase and become more attractive. But if you look at this pyramid, which I love, which shows Maslow's hierarchy of financial needs, cryptos and DeFi is really serving the two boxes in the red, people who are thinking of accumulating wealth and people who are working on financial freedom. Like, don't get me started. There's a ton of money locked up in legacy, focused on the big ticket sizes. And then we've largely ignored people at the bottom who just need basic banking, basic payments, basic transfers of money. And so I end today with saying that Cefi matters because there are still a ton of Cefi segments that are unaddressed by DeFi. I would argue that most of DeFi, as you can see here from this handy dandy market map, targets investment and trading use cases. So options, money markets, exchanges, short-term lending, also to help with trading, getting a bit into insurance. But there are such large segments with a lot of deposits, a lot of AUM left out there, including asset management. We've just scraped the surface. There's banking, payments and settlements. At Stellar, we're really focused on payments, settlements, money transfer to make it really cheap for some of these emerging markets. Lending for things besides trading, like real estate, car loans, student loans, you name it. And then don't even get me into payroll and accounting for small businesses. So I think I'm right on time. I don't know if there's any burning questions, but I hope you found that informative today, and I hope it inspires you to build out on some more use cases.
Thanks, Andrea. This was a fantastic talk. So we have 2 questions at the bottom, but
Oh.
we don't exactly have time. So if you want to drop in your Twitter handle, maybe they can ask
Yes,
you.
my Twitter handle's right on the slide. Feel free to direct message me or tweet me, and I'm happy to answer. Thank you.
All right, thanks, Andrea. We're going to transition to our next talk.